thank you again. It's great to be here in India. I arrived just a few days ago. I usually come once a year, and well, it's particularly auspicious to be today in coinciding with Akshaya Tritiya. I'm really looking forward to seeing this in action. We're going to go to Chennai later today, so again, I think it's going to be a very interesting experience for me. But for now, why don't we talk about the case for gold, or in particular, why or how to think about gold in the context of financial assets. So let me begin by talking about one of the key attributes or the key facts about gold that is oftentimes not well understood. And it is that gold is a global market. So gold oftentimes, obviously, gold is particularly important in India, and that is very apparent to all of you, I'm sure. But many investors around the world often think about gold as an asset that is primarily influenced by the effects of monetary policy in the US or the dollar and so on and so forth. And it is true that in the short term, that can be the case. In fact, oftentimes, people think that Indian consumers and investors do not influence the price of gold, or that they are not necessarily price makers for gold. And I would say that's quite the opposite. You know, they are quite important. Indian consumers, Indian investors are really important for the performance of gold. Perhaps not in the intra-minute or, minute by minute or hour by hour basis, but certainly on a year-by-year basis. Once you look at the overall picture of demand and supply, emerging markets overall make up more than three-fourths of demand, or almost three-fourths of demand, out of which India is one of the important components. It's the second largest market as it happens. Now, how to think about gold as an asset class, though? We have been talking right now about utilizing various passive instruments to get exposure to different asset classes. So why gold? Well, gold has three characteristics and can have three primary roles in a portfolio. Number one, it can be a source of returns. Number two, it can provide diversification, and we'll talk about that in more detail in a minute. It is also a source of liquidity. And when we combine all of these things together, that basically means that gold can improve the portfolio performance of an investment strategy, or the performance of an investment strategy, and in particular, the performance of investors' portfolios. And this is also true primarily of Indian investors. So you may be aware that gold is used to preserve capital. What you may not be aware is that actually gold has outpaced many asset classes over the past 20 years, over the past 10 years, over the past 15 years or so, 5 years, and so on, right? So when we look at the performance of gold in dollar terms over the past 50 years, so since the 1970s, when gold started to be freely traded, gold's returns have been about 8% on a compound annual growth basis. That is more or less equivalent to what the stock market with dividends have provided over that period, right? So, many people think that gold may track inflation and maybe it is not as interesting. In fact, actually, it has been very, very positive for portfolio contribution. And if we zoom in, or we look specifically about the experience of an Indian buyer, an Indian investor, you can also see that gold has outpaced certainly bond markets, and it has actually provided very competitive returns even compared to the stock market in India, which can actually has been also quite interesting and quite useful for investors. It has also outpaced commodities more general. The other characteristic that gold has that is quite important is diversification. I'm sure that you guys have heard this term diversification used a lot. So diversification is always used. We want to make sure that not all assets are into one place and so on and so forth. And diversification is very important. But it is also true that people don't want diversification. What they want is the highest returns possible. What we want is our money to grow, okay? It is just the fact that we cannot predict what will happen that forces us to have diversification. What is also important is that we should not confuse correlation with diversification. something can have, on average, low correlation and not be a very good diversifier. Why? Well, let's say that if we are primarily exposed to the stock market and the stock market falls, there are oftentimes many assets that in general have low correlation to the stock market, yet when the stock market is falling, everything rushes with it, right? So that is not diversification that is useful. You want to diversify in a way that when one part of your portfolio, a large part of your portfolio, namely stocks or bonds, when that is falling, that something else protects it, right? So what happens with gold is that it has a very useful characteristic. Not only it has low correlation overall to the stock market, but when the stock market falls, its correlation becomes more negative. What that means is that when the stock market is falling, generally speaking, gold prices tend to rise. And that is the type of diversification that you need. So when you're looking to diversify your portfolio, and again, it's great that you have exposure to the stock market. Don't get me wrong. It's great that you have exposure to bonds. But you also want to make sure that you have a well-diversified portfolio, and gold can be one of those assets that can provide the diversification. You may remember that a couple of years ago, in 2022, both the stock market and the bond market were under pressure, right? And gold was one of the few assets that rose that year, again, providing diversification. So it is important to understand that diversification is not just a term that we use and that just because something has low correlation, then I'm sorted from that perspective. It is important to think about the correct type of diversification. Gold is also a very liquid asset. That basically means that, well, as a collateral and as a store of wealth, people will typically buy gold from you. Nobody's going to say, oh no, I don't want your gold. Please take it away. People value that. And in general, again, there's a lot of liquidity in the gold market. That basically means that especially if you have exposure to gold through financial instruments, you can have very low bid-ask spreads. So you can get in and out of the market relatively effectively. So again, if you're in a period of stress, if the stock market is under pressure, you know that you can use part of your gold to give you cash or to give you some sustenance while the stock market recovers. And actually, we can see that in practice in India. Sometimes recycling, people selling their jewelry may increase over that period, not because they want to, but because they can use some of those savings to protect their wealth, right? Now, and that can be extended to the use of ETF, gold-backed ETFs or other instruments to get exposure to gold. When we combine return contribution, diversification, and liquidity, what that means is that generally speaking, gold is going to be able to improve the performance of a portfolio. And many times we get the question as to how much should investors hold in their portfolio. So our analysis suggests that, in an Indian portfolio, anywhere from like 5 to 15% can improve significantly risk-adjusted returns. And that obviously depends on the objectives of your clients as well as the composition of the portfolio. In other parts of the world, that range may change, but it is quite interesting. It's not too dissimilar, but it is really interesting to see how important gold can be for investors in India. Now, another question is, well, how do you get exposure to gold? Your families may already be buying a lot of gold in jewelry form. Again, today is Akshaya Tritiya. It's a very auspicious day for buying. Please go ahead and buy gold, right? But that doesn't mean that you cannot still get exposure to gold through other means. In fact, actually, a good example is in the US. When gold-backed ETFs were introduced, that did not cannibalize other parts of the market. People still buy jewelry. People still buy bars and coins. They also invest in gold-backed ETFs. All of them can provide a different type of exposure. When you buy jewelry, you're going to buy and hold it for a really long time. That you can still buy gold-backed ETFs and adjust your position. So they can be part of that strategy, even if your clients have direct exposure to gold through other means like jewelry. And you can actually see that collectively jewelry makes up about 35% of annual demand on a worldwide basis. In India, that percentage is higher. It's about 60 to 70%. Most people get exposure to gold through jewelry. But we have seen a nascent appetite for other types of vehicles, including, for example, gold-backed ETFs. Now, I have been talking so far about, in general, how to think about gold as a strategic asset, as a long-term component of your strategies. But how does the market look right now? So the first thing to note is that, as you may be aware, gold prices have been increasing over the past couple of months, and they have been reaching new highs across the world, not only in dollar terms, but in rupee terms and in euro terms and so on and so forth, right? So oftentimes, another question we get is, well, am I too late to be investing in gold right now, given how much it has increased? Right now, the gold price is about 70,000 rupees per 10 grams, right? Which, can be a psychological number that draws attention, right? So it's kind of like important to bear that in mind. So the answer to that is, number one, when you think about gold as a strategic asset, gold serves a purpose in the portfolio in the long run. In the same way that equities serve a purpose and that bonds serve a purpose, sometimes you may want to adjust your allocation. You may want to have more exposure or less exposure, but that doesn't mean that you should not have exposure. You should have exposure. It's just how much you adopt it. Now, what is interesting about the gold market right now is that one of the reasons why it has been increasing in price is because there has been a lot of demand from central banks, number one, and investors, especially in Asia generally, including the Far East, but also in India, right? So you have had positive effects coming from the East, even though we may not have seen as much appetite on the West. That in itself can be actually quite useful, because when we look at gold going forward, what we understand is that right now, interest rates are already high. That increases the opportunity cost of investing in gold, meaning, if interest rates are high, some people may prefer to put money in the bank as opposed to buying other things. But interest rates right now are not likely to increase so much. The US Fed Chairman Jerome Powell just in the last FOMC meeting basically said the next move is not likely up, meaning, rates will start to come down. So eventually that is going to be good for gold as rates start to come down. We may also see a weaker dollar. Again, that can be a positive headwind. In terms of tailwinds, the higher price may also create a deceleration in demand. If the price of gold is really high, people may not necessarily be rushing to buy jewelry. They can still invest, right? But they may decelerate that. So it's something to consider. But for gold, over the past couple of years, central banks have been an important source of strength, and they continue to buy gold because they are diversifying their reserves. They have too much exposure to the dollar, especially emerging markets, and gold is a means to diversify that exposure. Another important thing to consider is that so far, Western investors have been on the sidelines, which basically means that the gold market is not saturated. You can still see more investors come in. And the other important thing to consider is that Asian investors are still showing signs of appetite, right? If RBI is buying, if the PBOC is buying, that may encourage some investors to say, well, if they are buying, maybe we should buy too, right? So with that, I'm going to conclude my presentation by saying that as a World Gold Council, you may be familiar with us, but if you're not, we have a website called Gold Hub, where you can find a lot of information about gold, demand, supply, tools that you can use to understand the performance of gold, value your portfolio, and so on. So again, with that, I'm going to stop. I don't know if there's room for questions, but if not, I will, I'll pass the mic. Thank you.
The mic, please.
Hi, JC. Thank you so much. That was a very nice presentation. I just wanted to ask you, which is the efficient frontier for gold in a portfolio?
So that's a great question. Obviously, it depends on whether you are a U.S. investor or a Indian investor or a European investor. Obviously, your exposure to assets is going to be different. For Indian investors in particular, our analysis suggests that optimal allocations range roughly from 5 to 15%, depending on the rest of the portfolio. What I can also tell you is that the efficient frontier expands if you have gold than if you don't. So if you remove gold, the efficient frontier is going to contract, right? And what is important to note is that the analysis that we have done is very detailed. It's not just based on back testing or a specific period. We are doing Monte Carlo simulations to take into account the fact that equities can go up and down and move, sideways, and bonds can be doing other things. So this is a very robust way to think about it. And again, it really depends on the objectives of the investor and the composition of the portfolio. But generally, between 5 and 15% tends to be up.
And what would you like to tell this audience about why they should be recommending gold ETFs and not physical gold to their clients?
Well, I would say they should recommend everything. So just to be clear, buy jewelry, buy physical, but also buy gold-backed ETFs. And again, they can all coexist. What we can say is that gold-backed ETFs can be a very effective way, cost-effective way to get exposure to the asset, right? Why? Because, you're paying a relatively low management fee, and bid-ask spreads can be tight. It can be, small compared to maybe, 10, 15% or 20 or 35% markup that you may be paying on jewelry. So that is more of a buy and hold strategy, and gold-backed ETFs are going to be a great complement and very effective way to get exposure to gold's performance.